Let's move on to Chapter 2. Chapter 2 is the real heart of the introduction to managerial accounting. Chapter 1 gave you that selling features of why managerial accounting is important, but they really didn't teach you any managerial accounting. We're going to get into what is managerial accounting, particularly how are all the numbers tracked through the system. The one thing that I want you to know, most of the chapters assume we are a manufacturer. So we're going to move to manufacturing. In financial accounting, the textbooks you used, you probably started with a service business, and you spent approximately 4 chapters, maybe more, talking about the financial statements, the journal entries that are made by a service business. Their revenue was called fees earned or service revenue because they performed a service and the client either paid them or told them, hey, I'll pay you later, and we put it in accounts receivable. The only expenses they had were the normal administrative expenses, rent, insurance, utilities, and so on. Then you moved into the later part of financial accounting and you talked about merchandising businesses. They sold a product. They didn't make the product. They bought it already ready to sell. They put a price on it and they sold it. So then you had an income statement that said revenue, which was generally called sales. And you had this new expense called cost of goods sold. Because the biggest expense to a merchandiser is generally the cost of the item that they're trying to sell. And hopefully they priced it higher than that, so they made a gross profit, and then that was used to cover all the other expenses. We're going to go into a manufacturer. Again, they sell products. So their revenue is still sales. Expenses. These should seem pretty much the same. It doesn't look like I'm talking about anything different here. Talking about a manufacturer, their revenue is sales, their expenses are cost of goods sold, selling expenses, administrative expenses. You've seen those. This sounds like a merchandising business. So what's different? Okay, let's get that so you can see it on the screen here. Okay, the big difference is that cost of goods sold isn't just something that we can go look in the records and say, we sold it, how much did it cost us when we bought it? It's how much did it cost us to make? So we have got to do a lot of record keeping to figure out what it costs us to make the product that we're turning around and selling. That will help us determine if we're making any profit. What would be included in that cost of goods sold? We're going to have things like direct materials, just like raw materials. When you make something, there are some raw materials you start with. The examples in the book try to keep it really simple, a product that you can make with 2 or 3 materials. But if you go into a sophisticated manufacturing facility, you'll see that they have thousands of different raw materials. They get all put together, modified, cut, sewn, welded, all put together to make a finished product. So you got to keep track of what direct materials are going into the product. How many, how many pounds, how many yards of fabric, what did it take for the raw material? How much does each of those items cost. A lot of record keeping that way. And then you have direct labor. You have people who are putting those raw materials together, whether they're using machines, whether they're programming robots or overseeing a robot doing it. Somehow, the raw materials are being turned into a finished product with the assistance of human help. And then finally, you've got something called overhead. We'll talk about overhead in a minute. So there's the three components that go into the cost of goods sold. Those three things together, if we could track them, that's what a whole book is about, is trying to help us figure out how to track these so that we can come up with a cost of goods sold. We're going to do a real brief overview, kind of lay out the framework, but we're going to learn all the twists and turns as we're going through the course. Remember, we only want to know how much direct material was used in the products that were sold, not all the ones that we made, because we might have made a ton and only sold a small portion of those. So there's our kicker, trying to keep track of those things. The chapter opens with this discussion of costs. And costs can include direct materials, the same things we just talked about. Sorry, I'm running out of room here. I put some other stuff down below I'm going to need in a few minutes. Okay, I want you to remember that selling expenses is not one expense. It's a category of expenses. Sales commissions, advertising expense, various things that go into selling. It could be the depreciation on the equipment in the store. Administrative expenses, everything from his salary of the executives of the company to the utilities in the office building. The security guard's salary who oversees safety at the administrative building. We're going to talk about all these and break them down, but remember, these three go into making a product. So these three are called product costs. These two here, let's highlight them, are called period costs. Selling and administrative expenses are called period costs because they're recorded for a period of time. This is the selling expenses for the month of whatever, and they go on that month's income statement. So same way with administrative expenses, where these guys are tracked and kept track of as their product moves through the assembly process. So they're tied together with the product, not with a period of time. That's where the title comes in. Be ready to answer questions about any one of these. If I gave you any cost that would fit in these 5 categories, and you could slap a label on it, you could identify, oh, that one's a period cost, that one's a product cost, and so on. So being able to put the label on them is going to be real important. It'll make a lot more sense the more we do. So if it's still a little shaky right now, hang tight with it, and it will make more sense as we're going along. Remember, this chapter is trying to give you the massive overview, so it can seem overwhelming, but we're going to get there. We just got to slowly but surely build on the concepts. So the first place I'm going to go, hang tight, I'm going to pause for a minute here. Okay, let's continue with our discussion of the costs, particularly of the product costs. So I'm going to focus right here for a few minutes. A couple more terminology items that we're going to talk about. There's something called prime costs. It's just a big fancy name for direct materials and direct labor. The cost of making the product in terms of materials and labor are called prime costs. So if you added those two together, that would be the total prime cost. Then there's something called conversion costs. And those are the direct labor and the overhead. Notice that direct labor is in both of these. Conversion costs are the cost of converting the raw materials into a finished product. It doesn't include the cost of the raw material, but it's everything that you're going to spend or everything that you're going to incur to take that raw material to a finished product. Okay, a couple more things. Let's get into a real good definition of direct materials, because there's something called indirect materials. And direct materials are the items that go into the finished product. I know that might kind of sound silly and like, oh, what else would it be? That's why we're going to go into a discussion of what are indirect materials. Okay, indirect materials. If we are making, let's say, wood furniture, we take pieces of wood, we stain them, cut them, glue and nail them together and make beautiful pieces of furniture. There are things like saw blades, sandpaper that get used up in the process of making the finished product, but they don't become part of the finished product. If someone takes home one of our dining room tables, they're not going to find sandpaper as one of the elements of their new table. Hopefully not, unless we made some big mistake. But direct materials are things that they could probably identify if they were to really look at their table. It would be the wood and the stain and the varnish or lacquer that was put on top of the stain, the glue that held the wood together, the nails that are holding it together. All those things are part of the finished product. Those are direct materials. Indirect materials, like we said, saw blades, sandpaper, those things that we need in order to run the production process, but they don't become part of the finished product. Be careful on one thing. Sometimes inexpensive components get categorized, too many words here, as indirect materials, even though they are part of the finished product. Let's just say the product, that'll fit there. Back to our idea of that dining room table. If we used a little wood glue to hold things together before it was nailed, screwed together, no one wants to track 3 drops of glue that were put into the dining room table and try to figure out the cost of those 3 drops of glue and then do journal entries for it. It's usually so immaterial for some of these items that it's not worth tracking. So they get thrown in the indirect material, not because they technically aren't a direct material, but because they're such an immaterial amount that it's easier to put them in this category called indirect materials, which you'll see later what we do with it. But just because of its small dollar amount, it sometimes gets thrown in indirect materials. Now, what does this mean for direct labor? We also have indirect labor. And following that same pattern, indirect labor are wages of employees that make the products. For indirect labor, they are factory, this is going to be an important word, factory wages, but they don't directly make the product. Let's look at some examples. Supervisors, Sometimes they're called skilled trades. Repair people. If the robot, the machine, whatever doesn't work, these are the skilled people who know how to fix them, reprogram them, and make them right again so the production line can keep going. The maintenance staff, security staff, all those people are an integral part of the factory. They keep the place running. They each have a very important job, but they are not the people who are hands-on making the product. They support those people. So direct labor and indirect labor is all about whether you make the product or not. Again, if we started telling you about an employee and what they did, could you put them into the right category? Just as up here, if I told you about a component, a thing that we have in our materials warehouse, and described it to you, could you tell me if it's a direct or indirect material? So those are some things you're going to want to be able to do. And then the final, what is overhead? All the factory costs. Sorry, that equal is going to bother Excel, so I'm going to change it here. So all the factory costs that are not direct materials or direct labor. So it's indirect materials, indirect labor, factory. I'm going to keep stressing factory because they have to be related to the factory. If they were, let's say, this is factory depreciation. Factory utilities. Yes, I'm writing factory a lot. Okay, let's see what we got here. Indirect materials and indirect labor, those are part of overhead. They just get thrown into this big pile of costs called overhead. It's like everything else to do with the factory. And then depreciation, utilities, property taxes, anything else. If it says it's to do with the factory and it isn't a labor or a material that goes directly into the product, throw it in this category. But if it said the utilities for the store, that would be a selling expense. If it said the property taxes on the office building, that's an administrative expense. So watch for keywords that tell you these costs are related to the factory. Then you know you throw them in overhead. So hopefully now you can categorize all the costs into their right grouping. Where we're going to go next is looking at how the accounts are different. When you made a change from service businesses to merchandise businesses, you learned that merchandise businesses have an inventory account. They have a new asset that you hadn't seen before. Because the service businesses didn't sell a product, so they didn't have an inventory of products. So you learned how to deal with this inventory account. Manufacturers are a little more complicated. They have 3 inventory accounts. Remember, inventory accounts are all assets, so let's stick that in there. They're all assets because that's what an inventory account is. It's stuff that we own, but we own it in 3 forms. Materials inventory, I want you to think of it as like a warehouse full of raw materials, things that haven't been used yet. If we're making those dining room tables, it's a warehouse full of lumber. Has stain, paint, varnish, sandpaper, saw blades, everything that we could use in the production process, waiting to be used. So we buy it, we stick it in the back room, and then when the assembly line needs something, they have a communication system to that back warehouse and say, hey, bring out another so many board feet of lumber because we're ready to use it and we've run out on the assembly line. Oh, someone brings it out with a fork truck or something to the assembly line. So it sits in this materials inventory until it's needed in production. Then work in process. I want you to think of that as the actual assembly line. If you were to walk into this factory and take a tour and watch them making dining room tables, everything that's in process at the moment is in this category. This is work in process. If you could take a dollar amount of how much has been spent for the materials, labor, overhead of those things that are partially done as you take your tour, that would be this account. Finished goods, this is just like the merchandising business's merchandise inventory account. These are done products. We have completely finished making them. All they're waiting for is someone to buy them. So it's very much like our merchandising businesses that brought in completely made products, slapped a price tag on them, and offered them for sale. So when items are sitting here, I want you to think of that as a separate warehouse at the other side of the building that holds completely done. They've been through the process, they've been made, they've been shipped over here to finished goods, and now they're put in that warehouse until someone buys them. Maybe we sell to different furniture stores, and a furniture store will call us up and say, send us 10 more dining room tables. We'll go to this warehouse, grab 10, and ship them out to our customer, the furniture store. So what we're going to do is we're going to watch how costs flow through these three inventory accounts. I know we've just been through a couple of weeks of review, but I'm going to overstress this. Inventory accounts are assets. So we've got debit and credit side, not switching those around on it. And remember, since they're assets, the debit side is its plus side, is the side that you record increases. The credit is where you record decreases. So when materials inventory increases, it's because we buy some or purchase some. They'll use the word purchase probably more than they'll use buy. But if we buy some new raw materials, we'll put them in here as a debit. The reason that we would credit materials inventory is when we use up some or we move some inventory, some material to the factory floor. If the assembly line calls to the warehouse and says, please send us out some more, whatever, we're running low, it's going to come out of this account. So we're going to reduce materials inventory and we're going to increase work in process. I'm going to move this down just a hair because we're going to work through an actual story problem from the book. Let me find a good one in here and we will track it. Let's take a look at page 57. Let's make a note here. See page 57, exercise 2-37. In this problem, it tells us about the Chilton Company, and it talks about these three inventory accounts, and it gives every one of them a beginning balance. So I'm going to plop those numbers in here. For materials, it says my beginning balance is $14,000. For work in process, it says it's $8,000. And for finished goods, it says it's $9,000. Now we need to record any purchases that they made and track everything that happened in the account. The opening sentence says, in March, Chilton purchased materials costing $25,000. So $25,000 will be added in. They started the month of March with $14,000. They bought another $25,000. So while I'm not going to show it here at the moment, there's $39,000 in the materials inventory account after that big purchase. We'll deal with the labor and the overhead in a few minutes, but right now I want to kind of stay focused on the materials inventory account. I'm going to jump down here and give us lots of space. According to this problem, by the time March was over, there was only $6,500 left in the materials inventory account. Remember, we have $39,000 and they tell me there's only $6,500 left. It must have been greatly reduced during the month. And we talked about what would cause materials inventory to be reduced. It's when you use products. So they must have used or moved to the warehouse or moved to the assembly line from the warehouse a whole bunch of products. So I'm going to do some quick math and figure out how much. Got these two. Add it. Helps if I add them together. Here plus here. So that's going to add to 39,000, and I want to take away what's still left. That tells me that $32,500 was used up. Was taken out of the inventory and used in production. And what happens to it when it gets used? We can't just credit materials inventory without debiting something else. It's going to come out of here and go into work in process. So now work in process already had 8,000 in it. What does that 8,000 represent? That's the cost, the materials, the labor, the overhead of products that were sitting in the factory assembly line floor waiting to be finished. When February ended and March was beginning, the end of February, they all went home, shut the lights off, and left some stuff partially done. They weren't able to finish those dining room tables, but they got a good start on them. And they left them so that when they came back March 1st, they could just pick up where they left off and finish those tables. 8,000 represents all the costs they had already put into those dining room tables in February. Then in March, we had to do more material. That may be material to help finish those products that were partially done. And it's probably a whole bunch of materials to work on more dining room tables in March. So to start a whole bunch more tables, maybe start incomplete, but definitely to get a whole bunch more started. So now we have our beginning balance plus direct materials. The next thing that gets put in here is labor gets put in. And it tells us again in the opening sentence that $10,000 of labor happened during the month of March. And I'm going to make a note of what that is. We will forget, and now we can remember that we've got the beginning inventory plus direct materials that we figured out from over here, plus the direct labor, and one more cost. Remember, there's 3 product costs. And it tells us that $42,000 of overhead was also put in. So in March, we added a whole bunch more costs. And according to our story problem, we ended work in process with only 4,000 left. So in March, they finished up those things that were left over from February, and they worked at a whole bunch more dining room tables. And yes, when March was done, they still hadn't finished absolutely everything, but they got a bunch of it done. They left a little bit to be rolled into April to work on and finish in April. But just glancing at this, 8 and 42, that's 50,000, 60,000, $92,500 worth of costs here. There's a lot of costs. And there's only 4,000 left. So they must have transferred out of work in process a whole bunch of these dollar amounts. A whole bunch of costs got moved out of work in process. Where did the products go? Because these are product costs that are going to go with the products. These are going to finished goods. So the costs of the goods that we finished get moved to finished goods. We're going to do the same thing we did before. We're going to take all these costs. Oh, I'd hit the plus sign instead of. I'm going to add them all up. And just like before, I'm going to minus away what's still here. It tells me $88,500 was the cost of what was finished in March. Sorry, I want to call it a different month. I don't know why. So there was already $9,000 of dining room tables in the warehouse just waiting for their buyers. just waiting to sell them. Then we finish a whole bunch more dining room tables in March and put them in the warehouse too. So now the warehouse has got almost $100,000 worth of dining room tables waiting for buyers. Back to our story problem, the information they gave us. By the end of March, the warehouse only has 7,000 left waiting to be sold. So we sold a bunch of these dining room tables. We had nearly 100,000 and now we've only got 7. A large chunk of these were sold. We're going to do the exact same thing we did before. Add together what we had plus what we put in here and minus out what's still here. And that tells us that this is what we sold. I'll be very careful. That's not the price we charged our customers for these. That's what it cost us to make them. Remember, that's a combination of material, labor, and overhead, the 3 product costs. So how many of our dining room tables this represents? This is the total cost of making them. And just like before, we always saw that we credited and debited something. We always have to do equal debits and credits. We know we've got to credit finished goods to remove the items that were sold, but what do we debit? So we're going to move over, make another T account. And maybe you're even kind of thinking ahead with me. What would this be? It's not an inventory account. It's not one of the 3 inventory accounts. We've done with the 3 inventory accounts. This is cost of goods sold. It's an actual account. You probably saw it when you were learning about merchandising businesses. It's an expense, the largest expense a company usually has. Expenses, just like assets, are debit and credit. Debit is the plus side. Credit is the minus side. So when items get sold, they are debited into this account, the cost of making them. So $90,500 gets debited into the cost of goods sold account. Then we would compare this number to what we charged the customers for these items. Hopefully we charged more than $90,500 to the customers for them so that we can make a profit, because we still have all the selling expenses and all the administrative expenses to cover. So we can't just sell them for exactly what it costs us to make them, because we will never have enough to cover all those expenses. We have to build in a gross profit or a margin on them. So we are going to be looking at a lot of this. There's not going to be as many journal entries. A lot of times you're going to be talking about the numbers, but not necessarily the debits and credits. But knowing you have a year of financial accounting and you've been doing debits and credits and journal entries, I think it's good that I show you the journal entries behind all this. I don't think your chapter even deals at all with the debits and credits. We may in a later chapter. Now you have a big portion of the chapter understood. What I want you to see now and take a look at are all the cornerstones. I happen to love the cornerstones they put in these books. They teach you a little bit in the chapter, and then they take a second and show you what they call a cornerstone, which is an example. So of the concept they just talked about in the last 2 or 3 pages, here's an example. Try working through those. I know the answer is given there. So cover up the answer, work through it, and say, yeah, okay, I get that. I can do the same thing they did. If you can't, that's a sign that you didn't comprehend enough out of what you just read. And that's not uncommon. It's a lot of information, and honestly, it's not the most exciting reading. So it's easy to drift away from what they're talking about as you're reading and think you've been comprehending, and this is kind of the wake-up call to, hey, you kind of started daydreaming, and I don't think you grasped everything that was in the reading. So use those cornerstones as a pat on the back to say, you're getting this, you're doing great. Or a wake-up call to say, you need to reread that section. Cornerstones are great. They're going to walk you through a lot of what we've talked about. They're not going to draw the boxes or the T accounts that I did. They're going to show them more like financial statements or organized schedules that show the calculations, but they're doing the same thing. So walk through them slowly but surely. They're going to talk about the Blue Denim Company and show you all the calculations that they're doing to come up with the cost of goods sold. Everything leads to the cost of goods sold, which is eventually reported on an income statement. You will see the income statement for Blue Denim, the final income statement, which should look very similar to an income statement that you saw in financial accounting. There's nothing new there. They're just trying to explain how they got all these numbers. So on page 43 is the final income statement for Blue Denim, and all the pages leading up to it show you how they got those numbers. Really, the focus is on how they got cost of goods sold. Spend some time looking at this. You've got homework problems to work on that practice these concepts. Make sure you can do those. Your tests are open book because it's an online class. They are not, however, open friend or phone a friend. So you need to be able to, with examples from the book, from things with your notes, be able to solve problems like you're seeing and to understand them. If you have questions, you know how to reach me. Make sure you reach out and ask so that you don't move on to the next chapter, never fully understanding this chapter because it is so fundamental to the rest of the course.